Welcome to The Explainer. So, today we're diving into something kind of wild. We are going on a journey to really unpack an incredibly powerful yet completely abstract concept, the joint stock company. I mean, think about it. A company isn't a breathing organism, right? Yet it buys property, signs contracts, and raises absolutely massive amounts of capital. How does it actually structure itself to do all that? And, more importantly, how does it raise its lifeblood, the stuff we call share capital? Well, in this explainer, we're going to break down the accounting and the legal DNA of a company and transform what are usually dry textbook concepts into a really clear visual story. Let's get into it.
Here is our roadmap for today. We'll start with the anatomy of a company, move into the kinds of companies, then understanding share capital, track the issuance journey, and wrap up with special placements.
All right, part 1, anatomy of a company, bringing the entity to life.
Okay, so before we can even talk about money and shares, we have to establish exactly what this entity we call a company legally is. It represents the third stage in the evolution of business forms, and it has some truly unique traits. Look at this quote from Chief Justice Marshall. Read it carefully. He calls it artificial, invisible, intangible. Because by law, a company is essentially treated as an immortal, artificial person. It doesn't have a physical body, obviously, but because it's a creation of the law, it possesses specific rights granted by its charter. It is completely legally separate from the actual living human beings who fund it or run it.
And that concept brilliantly illustrates what makes this artificial person so incredibly powerful. Let's fire through these 7 defining features really quick. First, it's a body corporate, meaning it's officially formed under company's law. Second, it's a separate legal entity. It can literally open a bank account in its own name. Third, and hey, pay attention because this is absolutely crucial, limited liability. This means a shareholder's personal property is completely protected. Your liability is restricted only to the unpaid amount on your specific shares. Fourth, perpetual succession. Members come, members go, they might even pass away, but the company itself, it continues to exist until the law officially terminates it. Fifth, well, since it doesn't have hands to sign documents, it uses a common seal as its official signature. Sixth, shares in public companies are freely transferable. And finally, number 7, just like you or me, it may sue or be sued in its own name.
Moving right along to Section 2, kinds of companies, exploring the variations. Now, as you can probably guess, not all companies are built the exact same way. We can clearly see this when exploring the different species within this legal ecosystem. When we look at companies based on accessibility and the number of members, we primarily see this big division, public versus private. The absolute core difference here lies in who is allowed to buy and sell the shares. A public company is exactly what it sounds like. Its shares are freely transferable to the general public without you needing any special permission. A private company, on the other hand, it strictly restricts the right to transfer its shares and requires a minimum of just 2 persons to form. It intentionally keeps ownership within a closed, highly controlled circle.
Which brings us to Section 3, understanding share capital, the lifeblood.
So now that we know what a company actually is, let's pivot to the concept of share capital. Because our artificial person needs money to operate, buy assets, and hire staff, right? It has to gather funds. This capital is contributed by a large group of people called shareholders, who basically become the real owners. A company's total capital is divided up into smaller fractional parts that we just call shares, and there are 2 main types it can issue. Equity shares are your standard fractional parts. They form the basic ownership interest, and they carry the standard voting rights, plus all the risks of the business. Preference shares, however, are kind of like VIP tickets. They come with varying shades of special rights attached to them, which usually means a preferential right to receive dividends first or a priority claim on capital if the company ever winds up.
I want you to think of share capital kind of like a giant funnel. Let's look at how the math actually breaks down here. We start at the very top of the funnel with authorized capital. This is the absolute maximum limit the company is legally allowed to issue, which in this specific example is 40 lakh rupees. But hey, they don't need all that cash at once, so they only offer a portion to the public, which gives us the issued capital of 20 lakhs. Moving down, we see the subscribed and called up amount. Here, the companies ask the shareholders to actually pay 8 rupees out of their 10 rupee share value, totaling 16 lakhs. But, reality kicks in. Some people just miss their payments. We call those unpaid amounts calls in arrears, which we have to subtract. So at the very bottom of the funnel, the actual tangible cash the artificial person has received, the total paid-up capital, is 15,940,000 rupees. It is a perfect cascade from the legal maximum all the way down to cash in the bank.
Okay, on to Section 4, the issuance journey, the ticking clock. So, how do we actually get the public to subscribe to these shares? Gathering this money is definitely not as simple as just asking for cash. It is a highly regulated and very strict journey. Honestly, I like to frame the subscription process as a high-stakes race against time. On day one, the company issues what's called a prospectus, which is basically a formal invitation for the public to buy shares. And from that exact moment, a ticking clock begins. The company must hit a very specific funding goal by day 120. If they fail to hit that goal, no way around it, they cannot proceed with allotting any shares, and they face a super strict day 130 deadline to refund every single penny back to the applicants.
I really want to anchor your attention on this crucial number, 120. This 120-day limit is the absolute hard deadline to achieve what is legally called the minimum subscription. The directors calculate this minimum amount beforehand to ensure the company has enough funds to cover the price of any property it needs to purchase, its preliminary setup expenses, and its initial working capital. If the public demand doesn't meet this minimum threshold within 120 days, the whole shebang gets canceled.
Now, this naturally leads us to two common scenarios during this race: undersubscription and oversubscription. Undersubscription happens when the demand from the public is simply less than the shares being offered. Now, is this a total disaster? Not necessarily. As long as that 120-day minimum subscription goal is still met, the company can proceed and just allot shares to those who applied. Oversubscription is the total opposite. The company asks for a certain amount, but the public goes completely wild and applies for far more shares than are actually available. In that case, the company has to either reject the excess applications or make a pro rata, basically a proportional allotment.
Oh, and hey, remember those calls in arrears we saw at the bottom of the funnel? The folks who failed to pay the money they owe on their allotted shares? Well, the law doesn't just let that slide. Let's point out a pretty surprising technical rule from Table F of the Companies Act. If a shareholder misses a payment on their called-up shares, the company slaps them with a strict 10% interest rate on that unpaid amount. This artificial person definitely expects to be paid on time.
Finally, Section 5, Special Share Placements, Alternative Routes.
We've talked extensively about issuing shares to the general public, but that is for sure not the only way to distribute shares. Companies actually have alternative routes to raise capital or allocate ownership. First up is private placement, which is governed by Section 42 of the Companies Act 2013. This is how companies can bypass the general public entirely. Instead of issuing a public prospectus and stressing out over that 120-day clock, the company just extends an invitation to a highly specific, select group of persons using a private placement offer letter. It's quieter, it's more targeted, and often it's much faster.
Another absolutely brilliant alternative route is the Employees Stock Option Plan, or ESOP for short. Look, a company is an artificial person, yes, but it is run by very real human beings. ESOPs are a strategic tool used to reward and incentivize the internal team, the employees and the directors. By granting them the option to subscribe to the company's shares at a price strictly lower than the market value at some future date, the company creates a really powerful alignment of interests. The employees now literally have skin in the game.
So as we wrap up this explainer, I want to leave you with kind of a wild thought. We've seen how a company is legally birthed as an invisible, immortal entity. We've seen how it reaches out to the public, navigating strict deadlines to absorb share capital as its literal lifeblood. But at the end of the day, if this entity is just an artificial construct, who really holds the power? Is it the board of directors who steer the ship and make the daily decisions, or is it the massive, diverse group of shareholders who provide the crucial capital and ultimately hold the right to elect those directors? It is an absolutely fascinating balance of power that sits right at the very heart of modern corporate structures. Thanks so much for diving into the anatomy of share capital with me today.